So you welcome everybody to, this is what we like to call a special edition of the Not Your Average Investor Show, AKA Hall of Famer Paul Shively on the show, talking about cool things, bringing his fortune builders faithful that we love to welcome into our community over here at JWB as well, because Gregg himself is a member and a product of said community.
I am. I was the very first fortune builder student, I will have you know.
Very first. I'm your host, Pablo Gonzalez. We host a show called the Not Your Average Investor Show here that we do live on Tuesdays at 12:30. This is a special edition of that in order to share something very special with the Fortune Builders community. With me, as always, co-founder of JWB. I call him GC because he's got these like genius concepts, knows how to generate cash flow. He's a great co-host. And because his name is Gregg Cohen, say hello, Gregg.
Hello, everybody. Great to be with you.
And our infamous guest of honor, the great head of the Passive Income Club, a man who has been part of billions of dollars in real estate transactions. We call him the Jason Statham of real estate. I always find a new way to compliment him on his looks and make him extra uncomfortable. Today, I'm going to go with the polo shirt. We love the polo shirt. The first thing you did was hold up your arms. And can we see your bicep? One bicep?
No.
Paul Shively, everybody. Welcome to the show.
Good to be here
again.
You got it. You got me again. You find a new way to do it every time. I love it. I love being here. Like I said, every time it feels like home. I get to chat with you boys. It feels like home. So thank you.
It is home, brother. It's home. It's been home. We've been together for, I don't know, dozens and dozens and dozens of years, man. And it never ceases to amaze me. It's like, a long lost family or friends, you get on the call 5 minutes ahead of time and it's like you're right back in 2006, starting this whole real estate game again, finding great people. So
Amen.
Glad you're here, buddy.
Amen. Happy to be here. Happy all of you are here as well, too. This is a good one. This is exciting. This is a little bit of the bread and butter of all of our success, right? Is kind of comes back to this. So I'm really excited for this call. So thanks for having me on this one.
Yeah, we're excited for this too. We love it. We love it when the Fortune Builders family joins us on these special webinars. So welcome. Introduce yourself in the chat. Normally when we do our Not Your Average Investor Show, we have 60 to 80 people there that go to like every show. We got John Henning in the house. We call him our leadoff hitter of the community. He's checking in. So good to see you, John. We'd love to hear everybody else, where you're from, what you're calling in from. What made you curious about this tool? What I hear from Gregg is like the Fortune Builders folks, they love tools. They love ways to analyze their portfolio, to punch holes at numbers, to really grind the gears and jick the
a lot of this, right?
Shaking. I'm doing some Parmesan shredding. I'm doing some pepper shaking, some maracas, just play around with Excel and see all the money that you're going to make in the future and make really good investing decisions. So we are pumped to share this with you all. But my question for the three of you, I'm going to share the tool immediately in the chat right now for everybody that wants to see it. But you see, you spend like 3 months working in Excel, furiously typing away like a nerd in a basement. What is important about this? What made you want to create this new way of looking at a real estate portfolio?
Well, I'll tell you, my journey started as being the first Fortune Builder student. And so I know exactly what it's like to have this dream of investing in real estate, building a business, doing something that you absolutely love with the people that you love, and doing some really great things for others in this world. And I was there in 2006, and that's where I met Than and Paul and the entire Fortune Builders team. And where I was at that point was I knew I had found the right people to learn this from, but I didn't have the tools, the ability to make quick decisions as to spot what was a deal, what was something that I should put my money into. And through my relationships, through the team and the support that I received with Fortune Builders, I was able to acquire that knowledge. But I know not everybody has that type of opportunity to be able to be surrounded by Than and Paul Shively on a daily basis like I was. And so what I wanted to do was to keep that experience in mind and understand that people who are just getting started in real estate, and many times those who have bought properties but are looking to grow to the next level, they have the same questions. If I put my money in a property, how much money is going to be returned to me and when? And then you start asking that question, you want a quick answer. And then you start thinking about, well, what if I put only this amount down? What would my return on investment be? They start to say, well, if I held it this long, Or what if I chose to invest in this property over here versus this property over here? And all these questions came, and it usually takes people months, sometimes years to get those answers. And they might not even get the real answers. So where I went, the reason that I went into the lab about a year ago, and our team put this together over the course of the last few months, is a singular tool that can help you understand your real estate profits. And you can go in, we'll kind of go through the tool here today. We're really excited to show it to you. It's completely free and you'll be able to use it. You can understand if you want to build a portfolio of 3 properties or 5 properties, or, you want to put all cash into your investments or put a certain amount down. What's this going to look like 20 years down the road or 10 years down the road? Because I think it will help people be informed and make better decisions, quick decisions, so that you can put yourself in a position of financial strength.
Love that. Paul, you guys at Fortune Builders, you guys have been doing this same exact thing forever. You put C3X on the map, right? Like, you guys are notorious for creating these different ways to visualize different real estate strategies. From your perspective, the value of these like visualizations, these tools that you can tinker with to test your hypotheses, where do you see the value in this in all the people that you have helped? How does this tie into like the average person? Is it just like fluffing around, or do you think that there's real help here?
Yeah, it's a great question. I think it's, without trying to be dramatic, it's probably, if not the single most valuable thing you can do as an investor, definitely in the top 3 to 5. If you're thinking about answering the question of, how do I put my money to work in real estate, but do it, like Gregg said, in an educated way? That's the key. That's what we're all trying to do, right? We can all buy real estate, but there's a difference between buying and investing smartly with a plan. And what we found at Fortune Builders, I love, I'm actually really excited because I haven't seen all the final inner workings of this, so I'm pumped up, if you can't tell. Because what we found when we were helping do exactly what Gregg's talking about, coach people, educate people, because an educated investor is a better investor. What we found, we get on the phone with people, we do webinars with people. I'm a very visual creature. And most of you at home, do a quick mental check with yourself. Do you understand things better when you can visualize them? And I think it's better than 50-50, but most people are going to say, yeah, like visuals just help. And what we really found, and we're able to help unlock, and Gregg has taken it to a whole nother level, which is amazing, is when you can visualize your own money, you literally put your money on a spreadsheet, and then it becomes real. It's not just a hypothetical piece of property. It's like, no, that's my $250,000 retirement account. That's my life savings. This is my chunk of my money, X dollars, that I'm willing to put in real estate. What can I do with it? And you put it in something that visually shows what the options are. It becomes very real, and you can get emotionally attached to it, and you can see the outcome rather than like, yeah, I think this will work. No, I don't want to think. I want to, you can get kind of predict the future type of thing, right? And that's where it gets really valuable for the average investor. And I know this is not the average investor show. Average investors don't have access to something like this. The above average results come from this type of thinking, which is huge.
I like it, Paul, because when you first start talking about like being a visual person and a visual learner, I can totally relate to, this idea that as investors, we know that it's delayed gratification, disciplined action is what gets us there, right? Like, you're not going to get rich overnight, but if you can fast forward the tape a little bit and get a little peek about what you're delaying for, right? Like, it's almost like you get that pleasure neurons. You get the same kind of like release of endorphins as like looking at it on your bank account as when you see it on this like spreadsheet, like, oh dude, in 15 years, I'm going to have $1.5 million or, like whatever it's going to be, right? Like, I think that that's very, very real for me in my own journey.
I'll tell you, man, and I know going a little bit long here, but I want to drive this point home. I still do that, right? I'm 15 years into this journey. I've got, lots of portfolios. I still have that. I still struggle. I still have those evenings and those nights, and my wife will ask me a question, or another investor will ask me a question, and I have that little moment, right? That's normal. That doesn't ever really go away, right? Sometimes that's over like well, hey, how do I get my first one or two? Or sometimes that's over, hey, I've got a portfolio of 15 or 20 and I need to make a decision. That moment of that's okay. And these types of tools, whether you're a beginner or whether you're in this for 15 years or whether you're somewhere in the middle or vice versa, it doesn't matter. These tools help lower the anxiety, increase our education, and help us tie us to that outcome, like you said, Pablo, and give us that motivation to go get it, but also that inner peace, right? That's a big deal, right? Like, I don't care how much money I make. If I can't rest my head on my pillow at night and know I'm going in the right decision, I made a good decision, it's not worth it, right? Like, being confident in your decision making is a really, really important thing.
Love it.
Well said.
Yeah. All right. So that being said, I think we are at our cruising altitude right now. I want to welcome Amy and Keith, who've been with Fortune Builders and JWB since 2016. Tivon Douglas says, good day. Darlene Bayer from California. Leandra Henderson, good to see you. Bill Haskey in Chicago. That's a great Chicago name. Jack Garcia from San Francisco. Kevin, I don't know how to pronounce your last name when it's spelled NG. So I'm just going to Ing.
There we go.
Man, that was way easier than I was telling myself there. Okay, so we got everybody in the house. Leonard Clay from San Antonio. Charity Graham. Good to have you all in here. So GC, you ready to show this thing off a little bit?
Yeah, baby, let's do it.
Cool. So I'm going to put a link to this thing in the chat right now so that you can all see it as GC is showing this thing off. Let's share this. Are you excited, Paul?
I'm stoked, man. I'm stoked. I love seeing all the names in the comments too. It's great. I'm like scrolling through the comments. We go. It's great. Love it.
Well, really cool, guys. So let's just kind of start with some context here, right? When we're investing in real estate, it's really hard to understand what our rate of return is. You might see some returns that include this and that and the other thing, and you got to understand how much this appreciation rate is in this market. And then you got to understand, well, what is my maintenance cost? And all of the things that I'm going to show you here are already built into either based on historical assumptions for the Jacksonville, Florida market, or they're based on internal data from JWB for things like maintenance cost, vacancy cost, of course, property management fees and things of that nature. It's all data driven and it's all done for you. And as we mentioned, you can go and you can try this out for yourself while you're on the show here. It's free for all of our Fortune Builder friends out there. You can go to jwbrealestatecapital.com/profits and you can start to do exactly what I'm doing here on the show here. But it's really simple. You get to calculate the growth of your JWB real estate portfolio, and that's a portfolio based in Jacksonville, Florida. First thing you'll do is just select how many properties you want to own. For this example, we chose 3 properties. We asked, how long do you want to own them? We said 10 years in this example. And then we asked you, how do you want to buy, either with cash or financing? 3 questions, Paul. Do you think you can handle 3 questions?
You're reaching my limit, buddy. I'm
Paul
running out of fingers real quick.
So you put that in and you'll start to get some different scenarios. So this first scenario, what I'm showing you here is the output of this. And so it's just as quick and as easy as that. You go and you put those scenarios in. You can start to do this over and over and over again and run as many scenarios as you want. So for your first scenario here that we just kicked out, again, quick, easy access to high-level education and better decision-making is what this is all about. You want to see what one property owned in the Jacksonville market. If you hold it for 10 years, you put 35% down, your initial investment's a little bit over $91,000. Well, you're able to understand not just what your rate of return is here, which is almost 9%, not able to understand not just what your total profits are, but these profit centers that we talk a lot about, especially on the Not Your Average Investor show. The profit centers beyond just net rental income, which is something that we coach a lot of our students and our clients on, looking beyond just net rental income and understanding, how is my return going to be calculated? How are these total profits going to be comprised? Because as we talk a lot about on the show, it's a whole lot more than just net rental income is the reason why we love this asset class so much here. So there's one scenario right there for anybody who is interested in understanding what one rental property would look like. Mm-hmm. Well, over a 10-year hold, that one rental property investment, based on historically how Jacksonville has performed and JWB clients have performed, you're going to be able to put $165,000 in total profits in your bank account over that investing period. And your money's going to be working at about a 9% clip overall. For those who want to go and test it right now, you can go ahead and do that. But again, let's look at a scenario for 3 properties. Well, if we want to own 3 properties, again, we'll hold them for 10 years. We'll put 35% down in this one as well. you can see what our initial investment is. Well, it's around $275,000. Again, we're going to be earning about a 9% return on our investment, but our total profits are quite substantial. So, Paul, when you were talking about building a better retirement account and having the clarity today to see how this is going to perform for you 10 years down the road, how does something like looking at $500,000 in profits make you feel as far as confidence in putting your money into action today?
Yeah, I mean, it's the key to making it real. It's the key to, any kind of decision when you're trying to make the best decision for you and your family and your future. You want some level of certainty. You want some level of being able to predict the future and predict the outcome. And you want the reassurance behind it where you're not guessing, right? And so that's what leads it's just basic human psychology. The more confident, the more educated you are on something, the easier it is to make a decision, which is the best way I can sum it up, right? And we've been doing it, educating people on this for 15 plus years, and that's what it always comes down to. How do we get you comfortable with this so you can change your financial future? How do we get you comfortable, right? That's what it comes down to.
And I've never seen a tool out there that makes it this simple for rental property investing specifically. And I think the complexity and the fear that comes along with that is what keeps most people back from getting into this beautiful asset class. So hopefully this tool helps all of you. In fact, I would encourage all of you to go and try it. And if any of you have the courage to go out there and try it yourself, again, it's free for our Fortune Builders folks. So you can go and do it right now. Let us know what you're thinking as you're playing around with it as we're going through the webinar here today. I'd love to get your feedback on it.
Would love to get that feedback. Would love to get you all participating in the chat and also in the Q&A if you have any questions to ask. One of the things I want to just kind of highlight on this thing, we're seeing this really clean output here, but the key to this thing is the fact that you can put multiple properties, you can put multiple years, and you can put multiple percentages down, right? So like this idea of getting myself as a real estate investor, I do business with JWB. I go to them, I say, I want to build out this plan. They'll show me a property at first. And I'm looking at a single property and I'm thinking, okay, well, here's my ROI, here's my IRR if I want to get out at a certain amount of time. But let's say, I don't know, my kid goes to college in 16 years. I need to know exactly what that timeline is. When am I going to be able to pay for this thing, right? You can put it to the year, right? Like, so you can really understand where you're at that moment, as opposed to what I've seen in the past. And with other providers that, other providers might give you like just an ROI that is a 1-year ROI, not exactly a 10-year snapshot or just a fixed snapshot, right? Like in most best case scenarios, this ability to make it flexible, to add multiple properties at different times, and we're going to go over a couple different other scenarios, is really the key to this, right? Like whether you already have an existing portfolio and you see how other things mix, or you want to add things to it, or most of us really are kind of like counting down backwards from a goal, right? It might not be retirement age. It might be, hey, I want to go sail around the world when I'm 50 or whatever it is, right? But to be able to like hit one of these real life goals in a real amount of time, I think it makes a really, really big difference to be able to put the timeline in there.
100%.
So here's another one, 5 years, 5 properties owned, 20 years, right? Like, again, you are messing around with the years, the properties, the percent down. One of the things that you're going to start noticing here, the other, to me, groundbreaking thing in here, GC, is we take it for granted and we kind of like rushed into it as head of passive income, as co-founder of JWB, who's done 6,000 of these properties around town. The 5 profit centers, right? Like the misunderstanding of how rental properties have 5 profit centers. And some people might know that, but still don't realize how much one profit center really, really seems to like outweigh the rest of them.
100% on that. So let's just kind of go over what the profit centers are.
Yeah.
I'll give kind of a quick tutorial on that, and then we'll focus on one of the big misconceptions as far as how do you build this type of wealth? What does it look like after you have lived owning rental properties for 20 years like I have? Well, so you have your 5 profit centers. Number 1, we'll start with net rental income or cash flow. That's what most people think about, and that's truly what most people think about only. They kind of have these, what I call cash flow blinders. But cash flow is really important to make sure that you are mitigating your risks in this asset class. What cash flow or net rental income is the amount of money that's left over after you receive the rent each month and you paid all of the expenses, and you want that to be positive, right? And what that means is you've got an asset that is paying for itself every single month. Where many people get into trouble with cash flow is that's all they think about. And truthfully, many people think that, they get into this asset class thinking that cash flow is the only reason to do it. And they put this inflated sense of what cash flow needs to mean for this to be successful. They start to say, well, I need to achieve $200 or $300 or $500 of cash flow in my bank account at the end of every single month with a property. And the challenge here is that markets just aren't delivering that right now, not in the neighborhoods that you want to be in most of the time. And so they start to focus so much on cash flow that they make short-sighted decisions elsewhere in order to hit this cash flow goal. Some short-sighted decisions might be investing in the wrong market, might be investing in the wrong neighborhood, might be investing with a team that doesn't do a full-scale renovation on the property, might be investing with a team that has outsourced property management. So there is a double-edged sword when it comes to cash flow or net rental income. It's important for this asset class. It needs to be break even or positive there, but make sure, just know that cash flow is probably not going to change your life in the short run anyways. So don't fall overly in love with cash flow to the point where it makes you make poor decisions elsewhere.
Got it. So that's cash flow. Paul, you want to hit one of these other profit centers?
Well, I'd rather defer that to GC. And I want to just drive that point home if I could, because I think that's a really important one. And you were talking about it earlier, Pablo, which I thought was really cool the way you said it. And the way I like to sum up those decisions, and your short-term, long-term, Greg, it's making transactional decisions versus making a decision that helps you get to a goal. And I found a lot of average investors out there will make very transactional decisions. I'm only going to invest in an asset that has X cash flow. Or only, back in the day, it was like the 1% rule, the 2% rule, or what, all this quote unquote investor rules. You can only buy a house that has rent that's, all these things. Those are all transactional decision-making. You're coming from a core of, well, I have to hit these certain transactional things versus I'm going to invest that's going to help me send my kid to college in 16 years. That's a whole different set of rules and regs, right? And you unleash yourself from these traditional rules. I don't care what it rents for. If I can retire and help my dad buy a house in Palm Springs and retire, which he did from a couple of his JWB rentals, you can rent it for whatever the heck you want. You tell me I can do that? I bought 2 houses 11 years ago, and now I can retire my dad? Yeah, I'm on board for that, right? And so it's, hey, what do I need to do to get there? And then we got to fill in the blanks and go backwards, of course. But it's coming from a different place. It's a different decision-making mindset, right? And I don't want to just rip past that. And this tool allows you to do that. And it's not just net rental income. It's not just principal pay. It's not just one of these, like you're saying, Greg. Okay, if you're just fixated on a certain set of criteria for one of the profit centers, you end up making decisions that don't actually help your end all goal because you make some sacrifices on quality, sacrifices on team you work with, sacrifices on market you go in, or what have you. I don't want to skip past that point because I think it's a really important point of why are you doing this in the first place. Does that make sense?
Yeah, this is why you are a Hall of Fame guest on this show, right? Like, I love what you just did. For me, as somebody who is a marketer, I try to think of ways to help people understand concepts better. I try to help them take them from one way to another way that's better for them. You just described this idea of going from transaction-based investing to objective-based investing, right?
Amen.
Like, yeah, I love it. I love the idea of objective-based investing and the fact that this tool, by being able to add the years, the properties, and like the other minutia, like
Right.
the other inputs, allows you to really get to the exact objective that you're trying to reach and see how you're going to do when you get there, man. Really well said, my friend.
I love it. I think to me, it means understanding your why.
Yeah.
Understanding your why. And I get to serve both of you as clients, and I understand what your why is, and Shively, I understand about your why. And it's amazing when you think about those types of clients that are there to achieve things beyond just making money. Shively, for you, I know a big thing has been about taking care of your father, and you were able to achieve that dream and JW was able to be a part of it. So understanding your why is more important than any of these numbers that we're going to flash on the screen here today. You know what I forgot to do, actually? Well, we are flashing a lot of numbers here.
I don't know what you forgot to
I
do.
forgot to give our most fun disclaimer about not being a financial advisor when we start to flash all these numbers.
I do love that disclaimer.
All right, let me get that over here. All right, listen, we're talking real numbers here. I am showing you real numbers here. Anytime that I do that, I do need to give a disclaimer. Mr. Shively, myself, Mr. Gonzalez over here, we are not financial advisors.
I'm definitely not a financial.
We are not financial advisors. You're going to be looking at a lot of numbers here. These are estimates. They are not guaranteed, and we would encourage you to do your own due diligence whenever making a financial decision. Use this for the education that it is as a starting point, and then continue your discussions with those folks that you trust to make those decisions. So we got that out of the way. But long story short, when you're looking at these types of visuals, it helps you give confidence so you can ask better questions and then make better decisions. And that's really what we're hoping to accomplish here. I'll continue to go down the rest of the profit centers to wind that one up. We did net rental income. We've got tax savings, which I love tax savings. It's what I do on Friday nights. I just read about tax savings. So many of you out there, I'm sure, are right there with me, I would imagine. But you get these beautiful tax advantages just by investing in this asset class. And it doesn't matter how much money you make or what your job is, it's available to all of you. And you can see here that it really adds up. And so this tool allows you to have the understanding of just how impactful that is. I mean, if you had 46 grand that was just given to you, wouldn't you at least try to recognize that when you're making that decision? And that's, of course, what's estimated here on these tax savings for this portfolio that we've built. There's then principal pay down, which is your residents, your renters paying down your loans for you over time. It's another beautiful but sneaky benefit that we don't always think about as rental property investors. And most of you never capitalize on that. Most of you never think about that as a reason to invest in rental properties. How cool is it to know what it's going to be, again, right now, as you're building your retirement with this portfolio of 5 properties. And last but not least, the biggest one out there, home price appreciation. Home price appreciation, I think most of us know what that is, right? The value of your home's going up over time. Many people don't understand that it is predictable given a long enough runway. And a full market cycle is known to be between 10 to 20 years. And that's what this is based on, the average annualized appreciation rate over a full market cycle here in Jacksonville. And it's cyclical, right? That means it repeats itself over and over. So if you take 10 to 20 year segments of time, you're going to find roughly the same appreciation rate. And that's why we have so much confidence in the investments that we prepare for folks. It's like we know the answers to the test when we put a package and a portfolio together for a client. It's because if they're buy and hold mentality, I already know roughly how much money I'm going to be able to make them given the hold period of a full market cycle or close to that. It's because this asset class is so consistent and reliable. Now, your original question was, which one is the biggest contributor?
Well, I did kind of ask that, but I think it's pretty obvious when you come in here and you look at these performance here, right? So let's look at this one property where in 10 years, you get $96 in rental income, $2,500 in tax savings, $24,000 in principal pay down, $138 in HPA. You look at this next one, 3 years, 3 properties, 10 years owned. Again, the home price appreciation number, $414,000 versus $288 in net rental income. And then you look again in 20 years, 25% down, 5 properties owned, you get $1.8 million in home price appreciation versus this $43,000 in net rental income. $400,000 in principal pay down, $40,000 in savings, all real numbers. But this home price appreciation here clearly shows that it's the big one, right?
It is. And this is like a perfectly crafted retirement plan right here, a real estate retirement plan. And that's why I'm so excited about this tool and that all of you can use. It's because you can visualize, wow, if I can acquire 5 properties in the near future, and you might be 20 years away from retirement, you can know with confidence that this money is going to be there for you. Right? Now, this doesn't have to be your full retirement plan, but this can be your real estate retirement plan. And the best thing about a real estate retirement plan is that it is based on cash in your pocket growing over time. And the cash flow day one is not going to It's not going to blow you away. It's not going to change your life day one. But what will change your life is holding onto a portfolio of maybe 5 rental properties over a period of maybe 10 years or 20 years, building towards retirement. Because I can tell you, it does change your life 20 years down the road. And that's what this beautiful asset class can do for folks.
Well, you have a little bit of experience of life-changing investments in this stuff. What do you think when we're talking about this here?
Yeah, I think it's a wonderful visualization, and the fact that you've separated out that home price appreciation, because a lot of people, and I even, when I first started investing, was like, oh, well, that I can't count on that, and I don't want to talk about that, and it's just feels icky. Well, no, it's real. It's very, very, very real, and we can count on it, and we can predict the future by looking backwards. And are we going to be 100% right? No, of course not. No one is. Life. But we can make a really darn educated decision. Really, 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 really educated with really good data, right? And as someone who's done this, and someone who's done this for my family, done this for my nephews, done this for myself, done this for my father, it's real, right? And the fact that you can visualize specifically on the home price appreciation thing, I mean, I have lived that life. I have lived this exact scenario where I have had some of these assets for 8-9 years that I bought with JWB, and the home price appreciation alone, specifically, I'm able to tap into that, either refinance the asset, potentially 1030. There's a lot of things you can do to actually use that. And now, I got to hang out with my dad on Father's Day. Why? Because he was able to retire. And he actually moved 2 hours away from me instead of 8.5. And we played golf on Father's Day because of this concept. Like, it's very, very, very real. And that's, to me, why the education on this is important. Because the more educated you are, the better you can visualize it. And the better you can start to put your own money into these tools mentally, on a computer screen, on a spread, whatever it is. The more you can visualize that and do it yourself, for your own money, with your own timelines, that's when the power really starts to kick in.
Love it. We're going to get in and tinker with some of this stuff. Gregg has some scenarios laid out, but just want to remind everybody they can go to jwbrealestatecapital.com/profits, and you put in your name, number, and email here, and then it immediately pops up a on-screen calculator that allows you to punch some of these numbers in and see for yourself. Leonard Clay's having a little bit of problem working on his end. Leonard, I just checked it on my end, and it's working on the web form. So maybe try Chrome, or maybe like refresh your browser or something like that. That might help out. We got a couple of questions here, GC, before we jump in.
Cool.
You guys cool to take a couple questions?
Let's do it.
Mitchell Berman. Mitchell, I recognize you from, you were on the show on Tuesday, right?
That's right, Mitchell. Yeah, some great questions.
Yeah. He says, what about this model versus doing the same with commercial? Do you only use single family, or do you also use commercial properties?
Yeah, I'll take that one. So we are very big into single family rental properties as being the best risk adjusted returns. And that's what we do to serve our clients. So this is not a tool that's built on commercial investing. And JWB does not focus on selling commercial assets. While commercial and single family sound somewhat similar, it's both real estate, it's both renting out properties. There's actually quite a bit of difference when it comes to the risk profiles. I think many people are finding out the risk profiles of commercial assets are different than single family assets right now when we think about how interest rates have affected each of those different types of assets. And it all comes down to how the assets are valued. Commercial assets are valued based on the income stream. And when your cost of debt go up, your interest rates have gone up, the value of the asset actually goes down. There's other risks that come along with commercial assets. We're finding a lot of risks in the office space sector because of the changes of demand, because people are not going to the office as much as they did 5 years ago and before then. So there's just different risks. And, our ideal investor is somebody who wants it to be easy. They want it to be enjoyable. And they want it to be profitable to invest in an asset class. And single family is that asset class. Part of it is because of how the asset is valued. As interest rates have gone up, single family prices have gone up. And the reason is because the single family world is not subject to the same risks of interest rates as commercial is. In the single family world, you value the asset, what it's worth is based on what the neighbor down the street paid for the house, which largely is an emotional decision or based on what they can afford. And so it's a very big difference. So a lot of differences, but there's a reason that, we believe single family is the best asset for our clients. It's the best asset for me. I own over 400 of single family rental properties. I know you own 5 properties.
I do, yep.
Shively, how many do you own total now?
I don't mean to sound crass. I actually don't know because I would have to go back and count them up. It's several dozen.
There we go. There we go. So, and you can kind of see, I mean, we have access to all these different types of assets to invest in. And I think many people kind of say, oh, listen, I'll invest in single family for a little bit, maybe, and then I'll be on to something bigger and better. That's never happened for me, right? I love single family rental properties and, and I think people are starting to come around to that same mentality.
Got it. Anything you want to add to that, Paul? I know that you do some commercial also, right? But you also have dozens of rental properties.
Yeah, I mean, I don't think there's anything necessarily to add to what Gregg said. Have someone who does both. There's pros and cons for both. I think it's an incredibly good trajectory to start with single family homes is what we did. It's what a lot of people do. That's what we encourage people to do. Predicting the outcome to what you said, Gregg, predicting the outcome with single family is much easier to do. It's much, much easier to do. We can control a lot more of the factors, and a lot more of the consistent supply and demand is in our favor in single family world. It's why it will always be a large part of my portfolio. Always. Right.
High floor, right? Like it's a critical need. It's I put it into the part of my portfolio of I'm sure that this is going to work for me. And then I go take other riskier bets with other parts of my portfolio, right? So, you want some part of that safe part of your portfolio and you want to think about it that way. Gisela Casabella. Nice name. I like it. She's asking, the results for the tool, are there yearly results? For example, it tells me 30,000 in net rental income. Is this per year?
No, that is based on the horizon that you chose. So if you chose a 10-year horizon, that would be the total amount of net rental income or whatever profit center you're reflecting over those 10 years. If you chose a 20-year horizon, it would be the totality over those 20 years.
And Tavon Douglas says, can I start with one property? And if so, can I call someone to get it going?
Yes, absolutely. You can 100% start with one property, and the number to call is JWB's number. So it's 904-677-6777, or you can just send us an email at info@jwbcompanies.com. We're ready to help you do that.
What was the last 4 digits on the number so I can type it in? 677 what?
6777.
Wow, too easy.
Easy, huh?
All right, here we go. So, okay, I see a couple more here. All right, it's just kind of rolling. All right, so that being said, GC, this is a good tool also to calculate across markets.
Yes.
Right.
I figured that question was probably going to start coming in the chat here, right? If we can do this in the Jacksonville market, can we compare across markets since our fortune builders come from all different places in the country and the world? So yes, so we have that ability to do that. Now that is something that's a little bit more customized for you as a client. So that's where you're going to need to get on the phone with JWB and start to compare your property across markets. You have a property in this market, that property compared to another property here in Jacksonville. We're happy and excited to do that with you. You'll just want to schedule a time, and you can do that right on that website or send an email and schedule a time to talk with us for sure.
Got it. So you put a little work ahead of time to compare Jacksonville to Dallas, right?
I did. And, again, I'm trying to put myself in the shoes. Before I invested in my very first rental property, I had questions. Why Jacksonville? Why Dallas? Or why another market out there? And it's really hard to get solid answers there. There are so many variables for each market that you really have to have somebody who has an in-depth knowledge of each of those markets to compare apples to apples. And if you're like me, all I wanted in the beginning was just to have one comparison, apples to apples, and say, is this one better or is this one better based on the correct assumptions for each market? And so, what this tool allows you to do is to actually compare apples to apples. And so that's what I started to do here. I took a turnkey property providers pro forma from the Dallas market. And the first thing I wanted to look at, and the first thing that jumped off the page to me, was a huge return on investment. I love some audience participation here. If you are very if you have seen very high return on investment percentages offered on turnkey properties in the 15 or 20 or even 25% range, I would love to hear some feedback there, because that's what I see when I see other properties out there. And, JWB, our advertised rates are somewhere between about 8 to 10% is what our return on investment is. It's been that way since we began, because that's really what real estate produces here. But how could the property in Dallas show a 21% return, which is what we saw there? Well, I went and I tinkered a little bit, and I looked at those evaluations and how they drove those returns. And then I wanted to do this apples to apples comparison of a recasted pro forma, the way that JWB would show those same returns for that same property. And so that's really what you see here on this sheet here. There's the Dallas turnkey providers pro forma, and I'm sure we'll go through the way that they built that pro forma. And then there's a recasted pro forma, which is based on historically accurate assumptions.
Got it. So what, I guess if you're new to this and you don't understand, right? JWB's been doing this for 17 years. So they've done this with thousands of properties. You guys use internal data, right? You guys call it your data flywheel, where you're tracking every little bit of cost that goes into vacancy, into maintenance, right? Like you are reporting numbers based on performance, not based on bot numbers or something that you just asked ChatGPT out of nowhere, right? So again, you are, talk us through these performance of Dallas, of what you're seeing and what doesn't ring true based on your experience.
Yeah. So you've got your first line as your purchase price. So that's the same for both, but then you start seeing some differences. So the provider used a maintenance percentage of 0% in the first year for maintenance costs. I don't know if that makes sense to you guys, but it doesn't make sense to me. I manage 6,000 properties and I've never seen 0% maintenance cost for an extended period of time. 2 to 4% per year is what they use in the years subsequent to that. And that doesn't even make sense. What this means, 0% or 2% or 4%, you multiply that times the amount of rent that you receive for that year. Mm-hmm. So you're talking, if it's 2%, you're talking maybe, a couple $100 of maintenance cost each and every year. And I hate to break it to everybody, but that's just not real, right? Maintenance costs for rental property investing are higher than that. You've got many times families living in your homes for multiple years. And so they're going to be higher than that. So you can see in the recasted pro forma, I use JWB's internally data validated numbers of what actual maintenance costs are. Mm-hmm. And that's 7.5% of the gross rents that are collected in order to, recast the pro forma. That's the way that we would show those numbers if this was a JWB property.
Got it. So you kind of did this down the board here, right? Like you have somebody showing a vacancy percentage of 0%, which means like nobody ever moves out ever. How accurate has that been in your experience, Paul?
0% vacancy is, we have a saying in here. It works on our commercial properties. It works on our single family properties. It works anywhere. 100% occupied is a temporary situation. Always.
Yeah. Always. There you go. Yeah. Well, and you got to ask yourself why are turnkey providers motivated to put such low maintenance and vacancy percentages out there? Shively, I'll let you take that one. Why would somebody maybe be aggressive and going lower than what the maintenance and vacancy costs may ultimately be?
Yeah, I mean, and we talk about this a lot when we were doing a lot of education and we were doing rental boot camps and teaching people. It's just understanding how the property management industry works, right? And what's interesting is most property management companies, specifically if they are a third-party property management company, they're not an in-house vertically integrated like JWB is, where JWB is everything in-house, right? It's buying it, construction, fixing it up, putting a tenant in it, managing afterwards. It's all vertically integrated, right? When you have a third-party company that all they do is management, how do they make money? Very simply, they make money. Not really, if you look at their P&L, it's not really from the property management fee you pay every month. It's from when they turn over that tenant, that's when a majority of the money is made for that property management company. You look at their fee structure, the way it works. Basically, their fee to find you a new tenant is often half the first month's rent, maybe all the first month's rent. Well, that blows away their percentage fee you pay them, 5%, 10%, whatever it is, on a kind of monthly basis. So when you just look at the financial incentives of how most property management companies operate, they are literally incentivized to turn your property over into a new tenant every single year. And that is not in alignment with us as investors, where I would love to have an investor stay there until they pass away. May that be 80 years in advance, right? I wish the best upon that resident. I don't want to turn my property over. Why? Well, because it costs me a lot of money when we turn it over, right? So that's where you have an alignment of interest and a financial disalignment sometimes when you have third-party property management companies. So they're incentivized to say, well, we're going to have one-year leases, right? And that's where JWB really shines, right? Your average length of stay, Greg, is coming up on
4.5 years.
Very different, right? Very different.
There you go, brother. There's stepping inside the books of how a property management company actually works, right? And most investors in single family rental properties have no clue. That's the way it is. That's why vertical integration and alignment of goals is paramount.
That's amazing. So Amy Roberts, who's here with us, she's saying,
Amy.
Yeah, she's saying, wait a minute, but our 2016 JWB new build still has its original tenant. So she's got a tenant in since 2016, and she's got her other one has a tenant in since 2019 with JWB, right? There's a couple questions in the chat about like where her properties are. Just so everybody knows, JWB is a company that is completely vertically integrated, turnkey rental property investing here only in Jacksonville, Florida. It's really unlike anything else of just having 130 people under one roof, running the show from acquisition all the way through portfolio management. I'm a client, Paul's a client, really incredible outfit. So if that's what you're interested in, and you want someone that you can trust these numbers for, right? Like this idea of we're seeing how if you are, looking at a pro forma without a professional that knows the numbers, pumping it in for you, maybe you're looking at a different one. You may want to get on the phone with JWB, go to chatwithjwb.com and book a call, or in this landing page alone, once you go download, when you register for the sheet, there's a place to book a call there, and they can take whatever other pro forma you're looking at and pump it into this tool, right size the numbers, and make that happen for you. Because as you can tell, right, pretty easy to just like fib a couple numbers, and now you're looking at this eye-popping 21% when it's really 8.7%, right? And that makes a huge, huge difference.
Absolutely.
So if you were to like extrapolate that into, let's say we look now at Memphis, right? Use the same assumptions, right size it for these JWB assumptions. Now you're down from 26 to 11.1% GC, but there's a deeper kind of like thing to dig into here of right sizing numbers. You want to kind of like prep it for us?
Yeah, well, I think it's just very easy to use kind of industry standard or kind of, I don't know, round numbers when it comes to some of these numbers like home price appreciation and rent price appreciation. But, like for example, on the Memphis property, they used 5% home price appreciation. Well, I know the data actually shows from 1982 to 2023 that the appreciation in the Memphis market's actually 3.8% per year. That's the average appreciation. That really matters. That should matter to you when you're thinking about putting your money there as well. So it is a very common thing in this industry to inflate numbers and to put very high return numbers in front of you when you make decisions. But when somebody is actually responsible for holding that money for you, performing for you for 10 years, 18 years like JWB has, I know if I do that, there's no way I'm going to show up at the back end and be able to report that you actually had like a 20% return or a 30% return. It's just not real. And so I hope you all can appreciate these recats of numbers because you might have already thought that they were a little bit inflated. You didn't maybe think that 20 or 25%. So hopefully this kind of sheds some light on what the real numbers are based on historical assumptions and internal data.
Makes sense. And so a couple of quick questions here from Gisela Casabella. She's asking, when a property is vacant, do we still have to pay property management fees?
When a property is vacant, no. That's part of your goals being aligned. You don't have to pay property management fees when a property is vacant. It's based on rent that's collected. That's the way you should be requiring your relationship to be.
And does JWB sell homes with 100% financing?
No, I'm sorry, we do not. You're not typically going to find that with a turnkey partner, but I can tell you that we're masters at helping you come up with funds. And so if you get on the phone with our team and talk about what your goals and your resources are, more times than not, we'll be able to help you find the money either now or in the very near future.
So now, guys, we have right-sized these properties with Dallas. We've right-sized this properties with Memphis with the JWB numbers, and we see a much more accurate kind of like representation that don't have these like eye-popping numbers in the 20%. That being said, Paul, you referenced this a little while ago, right? Like most property management companies make their money on turns. Most property management companies, aren't giving these performance-based metrics from past performance. How do you feel about the average turnkey provider or property management company out there hitting actual cash flow numbers versus the ability to hit home price appreciation and hit all these other things?
Not good. Is the blunt answer, right? I mean, there's a reason. Like, look at our track record. Like, I'll just speak to the decisions we made, right, and our track record. What we did, and continue to do over the last 15 years. We get calls. I still get them at least once a month from a different turnkey provider, a different management company. Hey, can you look at buying some of our properties? Hey, can you get our company in front of your students? Right? We get it all the time. And there's a reason we've really only done business with a very small amount of companies, really only 2 companies ever in the last 15 years, truly. And there's a reason I'm on Gregg's radio show. And Gregg, you're the only external radio show I do. There's a reason, right? So I'll just let my track record, my experiences, where I've put my money, do all the talking there, right? Rather than kind of, I don't want to disparage or throw shade at anyone else. It's more just, there's a reason you do business with the right people. And I think that, again, it goes back to transactional decision-making versus making decisions from a different mental frame. We wanted to do business with and invest with people who made good choices and fundamentally believed the same things we believed, and then talked about the real estate afterwards. It was not a transaction-led conversation. It was a conversation always about ethics, integrity, business decisions. How do you do things when times get tough? And what decisions do you make, right? And how do you live your life? And that was always the start of any relationship we vetted out, because I was in charge of vetting out all the potential other relationships. And 99.9 of them failed for that reason. You start there rather than the real estate, it becomes real quick and real easy to answer the question, right? And JBB's passed and with falling colors and continues to do so. And Gregg, that's why 15 years later, you asked me to get on a radio show. It's heck yeah, man. How long do you want me for? Right?
Awesome, man. That was really well said. And thank you for everything you said there, man. It's goes right back to you guys, right? And I think about the genesis of our relationship. It's all about the people, and it's been, 15 plus years now, and the relationships haven't changed. We still joke about the same things and make fun of each other about the same things. So, it's one of the ultimate blessings in my career and in my life working with you guys. So I appreciate you, man.
Amen. Amen. And I think it's great, to put a finer points on it, to answer your question a little more directly, because I didn't want to skip past that part of the answer, right, Pablo? Because sorry, I'm getting blown up with text message. If you can hear all that, I apologize.
No, we can't hear it. You're good.
Good. I'm glad. I just said that for nothing then. When you put those same assumption sets on other assets in different markets, you can still make money, right? It's not like we showed, all of a sudden it's you can't make money here. No, that's not what we're trying to do at all, right? Like, you can make money in real estate a lot of different ways. You make money in real estate a lot of different markets, right? The key of why I'm trying to say this is, whether a company can do what they say they do, well, that proof's in the pudding. That proof's in how long they've been in business. That proof is in, how many repeat clients do they have, right? All of those things. You can ask really smart, intelligent questions to get to that. The reality is, and we teach people, you can make money in a lot of different markets, up markets, down markets. What I love the education is to show, here's how we compare things, apples to apples. So you're a smarter, better investor. And that's huge, right? But don't skip step 1. Invest with the right people. Do the right thing. Do your due diligence twice as much on the people versus the property.
We talk about that a lot on the show, right? This idea of the average decision-making matrix, the average order of operations is broken. So many real estate investors spend 90 to 95% of their time looking for a property. Then they'll be like, all right, cool. This is a property. This is market work. And then after that, they'll be like, all right, what's Craigslist say the 3 best property managers? I still say Craigslist, maybe Reddit now for the kids. They look for the 3 best property managers in the area, price that out, and don't really think about it. When the reality is you buy a property once, you own it for 30 years. So you are really engaging in a long-term relationship with that team. So the right order of operations is, hey, where are the best teams that can manage properties that are vertically integrated, that use proprietary data, that have a certain amount of scale inside their team, so that you have a team driving each different metric, not just like one person with 25 properties doing everything and that type of stuff. Once you find where that is, then you look at the markets, see what those dynamics are. And then if you got those 2 things right, based on your objectives and based on what you're trying to do, the property will show itself to you. And that's the right experience, right?
And that's, when we were really doing this really heavy on the education and getting in front of a lot of students, we would teach them what we would call that, Pablo, is an inside out approach versus an outside in approach. Most people take the inside out. Property first, everything else second. We exactly agree with you. That is the wrong order of operations. Educated, smart investors go outside in. The property is the last thing you look at. As far wide as you can. Who am I doing business with? Then are they in a good market? And then all those other things. It's outside in is the key to success.
Ronald Twang puts it, own the property, marry the team. I love that. All right. So to round this thing off, what we want to show is really what happens with the right team. We're going to show you now, going further into these assumptions, Greg. What are the numbers that you had to change further to like really right size that comparison that we just saw?
Yeah, absolutely. So when you compare apples to apples, the Jacksonville property is pretty close to the Memphis market and the Dallas market. It was between 9 to 11% there, and Jacksonville's right there at 9.7%. So when you actually compare apples to apples, a lot of these, I guess, preferred cash flow and growth markets that you hear of, Dallas, Memphis, Jacksonville, they're all going to be roughly similar, right? Jacksonville's right in the middle there. This is where your decision on your team and the due diligence you need to do that you both so eloquently talked about becomes so critical. Because what I want to share with all of you is just how sensitive these numbers are to your maintenance and your vacancy costs. Because while net rental income is really important for risk mitigation for us, because it's when an asset pays for itself every single month, it is the riskiest of the profit centers for you to actually receive. And the reason is because you might not be working with a team that is qualified to deliver long-term leases, long-term resident stays. They might not focus on renewals. They might not care tremendously about the resident and that relationship. And if you have one of those experiences, guess what happens to your maintenance and vacancy costs? It skyrockets. So just knowing the numbers, right? We internally have estimated maintenance and vacancy costs of 11.5%. That was used on these numbers that we talked about. Well, that's based on our average resident stay of 4.5 years. If you're working with a turnkey provider that maybe has outsourced property management, maybe they only sign 1-year leases, maybe their average duration of resident stay is only 1 year. Well, guess what? Those maintenance costs that they may have reflected 0% on the eval, now it's 32%. And 32% maintenance and vacancy cost happens when you have 1-year turnovers. And unfortunately, that's what most rental properties experience, rental property investors experience. And that's why their returns don't stack up to what these evaluations originally said. And that's why they're so frustrated. So I couldn't urge you more to focus on that due diligence of that team, because if you do that, that's the only way that those pro formas are actually going to translate into dollars in your bank account.
You see, before we show the numbers of what happens when you put in that 32%, because that sounds astronomical. To go from like 4 to 32% sounds astronomical. I just kind of want to do the mental math on what it means, right? Like if we're talking about a property that turns once a year, right? So you have someone in there for 12 months, then they move out, right? Once they move out, you're going to have to bring people in to paint the walls, to do some like minor fixer-uppers. That's part of the cost.
Mhm.
You're also going to have people not paying rent for like 1 to 2 months as well.
Mhm.
That's another part of the cost that you're adding in there. And then you also have a tenant placement fee, which is usually 1 month's rent.
Exactly.
Those are 3 parts of the cost that if you start having that happen every 12 months, that's how you start seeing that 32% versus this idea of Amy's experience where you have somebody living there, you say average 4.5, she's had a little bit more than that, right? But
Mhm.
like every 4.5 years, if you start making that cost happen every 4.5 years versus every year,
Yes.
completely different, right? So like now if you plug that thing in, now we're looking at these Dallas properties, Memphis properties, and Jacksonville properties as a completely different ranking of where the total ROI is.
Exactly. That's what most unsuccessful rental properties investors experience, you know, and I would love to hear if anybody's experienced this. Did the cash flows not equate to what you thought? Right. I know it's out there, and that's what keeps people away from either reinvesting in this asset class, or maybe they talked to a friend and they scared that friend from ever investing in this asset class. That's why the value of that team is so important. But the numbers that you're looking at here show what a 1-year turnover, routinely 1-year turnovers would mean to that Dallas property or that Memphis property. It takes those returns, which originally were 21% or 26%, now down to 7%, 8%, you know, and it can be worse than that, of course. But I think what's hidden here is not just the returns are so much lower, it's the frustration of every year dealing with, is my resident leaving?
Yeah.
And I have to put more money into the property I wasn't expecting. Those conversations around the dinner table with your spouse are not fun when you have consistent 1-year turnovers.
Yeah.
You know, and then go back to what Paul was saying early on in the call about the importance of peace of mind when you're investing. If you're having that, none of the returns matter. It doesn't matter what they are. And the way that you can mitigate the risk for that is to be here on this call. So I applaud all of you for being here. I would encourage you to continue to show up to the Not Your Average Investor Show and continue to follow all the Fortune Builders education that you can. And then to make sure that you do your due diligence to work with a team that's worthy of being a steward of your money.
I love it, man. Thanks for putting this work together. Paul, we got a couple more questions here. Do you have anything else that you want to add or anything like that, Paul? You're good?
No, I love the fan interaction and engagement. Let's go.
It's been great. It's been great. Okay, so let's start with Bella Kogan's asking, are you still working with Memphis Invest, Paul?
Yes.
Okay, cool. So another option out there. Mitchell Berman, what's your relationship with Van Merrill?
My relationship or,
I guess.
or GC's? GC, you take it.
You know, Than is like a big brother to me. He's like my big brother in real estate. I met Than at a conference 18 years ago, and it was one of the best relationships I've ever made. And yeah, so he's a good friend of mine. And of course, our companies have done business together now for 18 years. And it's truly special to do business with somebody for 18 years, sell thousands of houses, and to have that type of friend and resource, you know, and it never changes. Like I said, we make fun of each other the same, like we did 18 years ago. It's the same way we do it now. So yeah, very strong relationship.
Have similar jaw structures as well, right? Is that accurate? All right. Tiffin Douglas asks, what is the lowest percentage you can put down on a property?
The lowest percentage you'll be able to put down if you're using conventional financing is 20%.
Okay. Gisela Casabella asks, if I pay the down payment with a loan, should I put 0% down payment in the calculator since I will still have to pay this loan?
Well, this calculator is built using conventionally financed terms. So the lowest amount you'll be able to put down is either 20 or 25% on the calculator. Can't remember.
Okay. And then finally, Melissa Williams says, what's the key to keeping renters there longer?
What is the key to that? It comes back to goal alignment. If we go back to earlier on in the conversation when Paul was talking about the alignment of goals of a typical property management company, I think it all comes back to that. You've got to work with a property management company that is incentivized, that they make more money when your residents stay longer. And one of the problems in the property management industry is most property management companies make more money when your tenants stay a shorter amount of time. And like Paul was talking about, they get more fees, they get more dollars per hour of work when they receive new tenant placement fees. And so JWB is built differently. That's why we love our residents staying 4.5 years, and I hope they stay longer. It's because we make the majority of our money when folks buy houses from us, when they buy investment properties from us. And so we knowingly give up fees that we could charge on the property management side because we've seen how when we in essence, build our business to give up those fees, we more than make up for it when clients come back and buy more and more houses. And so it can be a win across the board for both the client, for the resident of the home, and for JWB when we structure our business this way. And this is the essence of vertical integration. So there's so many business decisions and policies and things that come that actually allow the residents to stay 4.5 years. And maybe we'll dive a little bit deeper into that in a future Not Your Average Investor show. So I'd be happy to continue to answer this question. I won't have so much time today, but I can tell you it all starts with alignment of goals and a vertically integrated team where the same property management company is under the same roof of the company that's selling it to you.
Chat, are we frozen or is Paul frozen? Let us know in the chat. Oh, okay. Darlene says we see us. Paul, we're losing a little connectivity. I think this is the world telling us that we got to let you go, man. You're a busy man. Never disappoint, my friend. After doing, 12 shows with you, I feel like I couldn't possibly learn any more from you. And then you show up today and totally redeem yourself with this subjective planning versus transactional planning, man. I got a lot out of that. I always appreciate you coming. I appreciate you bringing the Fortune Builders faithful, the brethren here of Fortune Builders that always show up in full effect. If you want to tinker with the toy over here that Gregg developed, go to the link, jwbrealestatecapital.com/profits. If you want a professional to massage these numbers in a way that right-size them for the different assumptions in the different markets, right in that webpage, you can schedule a call, jump on the call with the team. First call with JWB is everything that we talked about. It's relationship building. It's trying to figure out what your objectives are and if this thing makes sense for you. It's a great call to take. I highly encourage it. It's kind of like going to an In-N-Out Burger or a Chick-fil-A. You never talk to anybody there that isn't going to leave you in a better mood than when you first arrived. So it's a great team to interact with. GC, anything you want to end with?
I just want to say thank you to everybody who's here, especially our mutual clients here, our JWB and our Fortune Builders folks. I seen Darlene Bayer saying hi, Amy Roberts, everybody here. Thank you guys for sharing your experiences. There's just nothing like the clients that we get to serve together. So thank you all for being here. Paul, it's been a pleasure, my man. Can't wait to do it again with you. And yeah, excited for the next time.
Let us know when you get our mail, Paul.
Will do.
All right, see you next time.
See you
guys.